So, good morning. I need to be someone listening. Okay. So, have we done the leases? We have to start on the lease. Yeah, so let us now go to the lease. So in the handout I gave you for the bond refunding, it has some details about the lease. It has some details concerning the lease. So lease is basically where you rent a property. Then you pay the rent to use it. But now we normally compare the leasing and the buy option. Then in the process, we shall come up with which one is the best in terms of comparison of the two. So we shall go straight to the questions. I want us to go straight away to some questions on that item of the leases. We go straight on the questions on the item of the leases. So one of the question that we shall start off with. So one of the question that we shall start off with should be the one for December 2011. December 2011, question 1. We start with December 2011, question number 1. We start off with December 2011, question number 1. December 2011, question number 1. You have found the question. So the question reads that Motor Limited is considering whether to buy a certain machine. Costing 100 million, or to lease the machine. So it is estimated that the machine will reduce variable cost by 31 million. It will reduce the variable cost by 31 million per annum. The machine will have an 8-year life with no salvage value. The machine will be depreciated on the straight line basis. The machine will be depreciated on the straight line basis. Then the company's optimal capital structure is 50% debt to the total assets, and it is before cost of the debt and respectively cost of equity are 15% and 25% respectively. So you are also given the corporate tax rate as 30%. Then if the company were to lease the machine, the fee will be 21.4 million per annum paid at the end of the year. Assume that the lease is a finance lease. So required net present value if the firm decides to buy the machine. Roman letter 2, net present value if the firm decides to lease the machine. Then finally advise the company on whether to buy or to lease the machine. So let us start with the lease of Roman letter 1, which is now the buy option. We start with the Roman letter 1, which is meant to be the one for the buy option. So we start off with option 1. So option 1, it is simply buy option. Option 1, it is simply the buy option. So we start off with option number 1 in the Roman letter 1, which is basically buy option. So we want to compute the net present value. You want to get the net present value. It is given by present value of the cash inflows. We minus the present value of the cash outflows. So it will be given by the present value for the cash inflows. We minus the present value for the cash outflows. So what is lacking is the cost of capital. So cost of capital is not there. We need to come up with the cost of capital. We need to come up with the cost of capital, which is meant to be the WSEC. So WSEC is supposed to be given by weight of equity, cost of equity, weight of the debt. So KD must always be after the tax. So to calculate the cost of capital should be the same as the WSEC. So I want you to check in that paragraph number 2. If you can check the paragraph number 2, they were able to give you information that the company's optimal capital structure. The company's optimal capital structure is 50% debt to the total asset. And it is before tax, cost of the debt and the cost of equity are 15% and 25% respectively. So the weight for equity is also 50% because there are only 2 of them. If the debt is 50%, it is obvious equity must also be 50%. So 50% will be the same as 0.5. So KE is the cost of equity. When you continue downwards, what are you given down there as the cost of equity? So before tax, cost of debt and the cost of equity are 15% and 25% respectively. So which one is the one for equity? The one for equity will be 25. The one for equity is 25. So the weight for the debt is also 50%, which is 0.5. KD is the cost of the debt. They have given us which percent? 15%. So it must always be after the tax. The tax rate is 30%. So 1 minus 0.3 will be the same as 0.7 multiplied by 0.7. So that now should be in a position to give you what is supposed to be the WSEC, which should now be our discounting rate. To give you the WSEC, which should now be the discounting rate. Which should now be the discounting rate. It should now be the discounting rate. It should be the discounting rate. $17.75. I've seen online someone has given me 17.75. So after that, we also prepare the cash flow statement to get the cash flows to be discounted. We now also prepare the cash flow statement. So this one has been given 17.75%. So cash flow statement will give you the cash flows to be discounted. Cash flow statement. Cash flow statement will give you the cash flows to be discounted. So to get the cash flows to be discounted, for us to get the cash flows to be discounted, so whether you buy or you lease, there is some savings. The question has given you savings on the variable cost. You can see that in the first paragraph, where that machine will be purchased at 100 million or lease the machine. So it is estimated that the machine will reduce the variable cost by how much? 31 million. So we start with the savings on the variable cost. We start off with savings on variable cost. So that savings on the variable cost is 31 millions. We have the value of 31 millions. Then apart from the savings on the variable cost, now you less depreciation, you minus depreciation, which is on the straight line basis. So because it is on the straight line basis, initial cost has been given as 100 million. They said there was no salvage value. Salvage value will be 0, but economic life, they gave us how many years? The economic life is given us 8 years. So when we calculate that, so what should be our depreciation? 12.5 million. That is the same as 12,500. So you subtract so that we get the savings before the tax. Savings before the tax. So that we get the savings before the tax. So what should be the savings before the tax? 18,500. Then now we less the tax. We minus the tax, which should be 30% of 18,500. Which should be 30% of 18,500. So what is 30% of 18,500? 55.50. So when you subtract, we now get the savings after the tax. We get the savings after the tax, which should be 12,950. Then after that, we add back depreciation. So we add back. Depreciation is not an actual outflow of cash. That's why after taxing, we add it back. The figure was 12,500. So that we now come up with the annual cash inflows. Annual cash inflows. Annual cash inflows. 25,450. So after that is now when we can come up with our NPV. So let us now get the NPV from that point. We now compute the NPV from that level. So to get the NPV, compute the NPV, we have said that NPV is supposed to be given by present value for the cash inflows, whereby you take the annuity multiplied by present value interest factor for the annuity. We have calculated it was 17.75% for 8 years. So annuity is 25,450. Is 25,450. So 17.75% is not in the table. I have been showing you how to calculate the value, just in case it is not in the table. Just in case it is not in the table. So if it is not in the table, remember that 1 minus 1 plus r raised to the power of negative n divided by r. So it will be the same as 1 minus, so r is now the 17.75, that is 0.1775, raised to the power of negative 8 Also divide by 0.1775. That figure, remember to round it off into 4 decimal places. That value, remember to round it off into 4 decimal places. I've seen 4.1093. I've seen online 4.1093. So 4 points. So it is 4.1093, like that. So now from there, you multiply that figure by 4.1093 to give you present value for the cash inflows. Then now we less present value for the cash outflows. Present value for the cash outflows. So present value for the cash outflow is the initial cost of the project, which was basically 100 millions. It was given as 100 million. So I have 3 zeros at the top. I will just hand it like that. Then you get the net present value at that level. You now get the net present value at that point. You are getting 4 millions. 4,581, 685. So that is for the buy option. That is now the NPV for the buy option. We need also to compute the one for the lease option. We should now be in a position also to calculate the one for the lease option. The one for the lease option. Let us go to the lease option and see what we shall get from it. Let us now check the lease option. So still on the lease option. So still on the lease option. So still on the lease option. Still on the lease option. So lease option is our Roman letter 2. So we still want to get the NPV. NPV should also be given by present value for the cash inflows. We minus present value for the cash outflows. So first, we prepare the cash flow statement. First, we prepare the cash flow statement. We prepare the cash flow statement. We shall first prepare the cash flow statement. So we start with the savings. Whether you buy or you lease, there is the savings in the variable cost. Whether you buy or you lease, the first item is savings on the variable costs. The first item will be savings on variable costs. So that savings on the variable cost was given to you in the first paragraph. The amount is 31 millions. The amount is 31 millions as the savings on the variable cost. But now when you lease, check in the last paragraph. Check in the last paragraph, when you lease, they have stated that the corporate tax rate is 30%. If the company were to lease the machine, the fee will be how much? 21.4. So we less that lease fee. Yeah. Now when you lease, there is a fee you are going to pay. So we less after the savings, we now less the lease fee. We minus the lease fee. When you lease, there is a fee you will be paying monthly. That fee they have said it is how much? 21.4 million. So we minus 21,400. There are 3 zeros at the top. So that we get the savings before the tax. Savings before the tax. How much should be our savings before the tax? Sorry? 8,600. 9,600. So when you lease, there is no depreciation. I want you to note that. When we lease, there is no depreciation. The asset does not belong to us. We are only paying rent to use the property. So when you lease, there will be no depreciation. Unlike when we buy, we depreciate the machine because it is ours. So there is no depreciation under the lease. Then now we less the tax. We now less the tax. We minus the tax. Tax rate should be 30% of 9,600. The tax rate should be 30% of the 9,600. We should be 28.80. When you minus, now we get the savings after the tax. The savings after the tax, which will be the same as our annual cash inflows. Which will be the same as our annual cash inflows. 67.20. So that is now our cash flows we are going to discount. So now we get the present value for the cash inflows. We now get the present value for the cash inflows, whereby it will also be annuity multiplied by present value interest factor for the annuity, 17.75% for 8 years. So that annuity is the 67.20. It's the 67.20. So we had already calculated 17.75% in year 8. You remember? It was 4 point what? It was 4.093. That figure, we had already calculated it, the discount rate. So you are meant to less the present value for the cash outflow. But now it is not there. We leased, we did not buy. So 100 million is not there when you lease. This one will just be a 0. When you lease, the 100 million is not there. You remember there was no depreciation. You did not buy, so you did not incur that cost. So now you get the NPV at that point. When we lease, there is no initial investment. When we lease, there is no depreciation on that basis. So that we now come up with the annual cash, the NPV. So that we get now our, when you lease, the 100 million is not there. You did not buy, so we shall only apply. So it should give us which figure? 7? 27 million. 614. 496. So that should be now our option to lease. So when you lease, remember there is no initial investment. So also there is no depreciation on it. So now you are meant to advise in the Roman letter 3. So which one has a highest NPV, lease or buy option? Which option has a higher NPV? The one for this. Yeah, so when you lease, so lease option. So the advice would be that select the lease. That's now our Roman letter 3. Select the lease. Select the lease since it has a higher NPV. We select the lease since it has a higher NPV. So another question on the list is September 2021. Question number 3, part B. September 2021, question number 3, part B. We now check September 2021, question number 3, part B. September 2021, question number 3, part B. September 2021, question 3, part B. September 2021, question 3, part B. So the question reads that, Celtex Limited intend to acquire a mainframe computer for processing and storage of its data. For the processing and storage of its data. The computer is expected to cost shillings 800,000. The finance director has made 2 proposals for acquiring the computer. Has made 2 proposals for acquiring the computer. Proposal 1, they are saying leasing option. So when you lease the computer for 5 years before the new model is introduced, lease payments constitute shillings 150,000 per annum for 5 years. Repair and maintenance costs incurred are estimated at shillings 100,000 per annum for 5 years. The firm can choose to exercise the option to buy the computer for shillings 100,000 after 5 years. That's now the lease option. Then kuna purchase option. So under the purchase option, they have also stated that the firm can borrow shillings 800,000. The firm can borrow shillings 800,000 from a from a commercial bank at an interest rate of 16% per annum. At an interest rate of 16% per annum. To finance the purchase of the asset. So the interest on the loan is payable on the reducing balance basis. Then they have also said that salvage value of the asset is estimated to be how much? 150,000 after 5 years. So depreciation is on the reducing balance basis. So corporate tax rate is 30%. Service and maintenance cost will amount to 80,000 per annum. So required evaluation of both option 1 and option 2. Then finally advise the company on whether it should buy or lease the asset. So let us start with the lease option. We start off with the lease option, but before we do that, we need to get the cost of capital. We need to get the cost of capital, which has not been given. Even the other question, it was not given. So this time around, to get our cost of capital or discounting rate, cost of capital or the discounting rate, the cost of capital or the discounting rate, you simply take the interest rate. You see the interest rate of the bank loan in under the purchase option. That interest rate on the bank loan, it is what percent? So just take the 16%, then we tax it. There was no equity in the question, so we now base it on interest. So corporate tax rate was given as 30%. So we simply tax that figure like that, so that we come up with what is supposed to be the cost of capital. Simply take the interest rate, then tax that figure. So when we do that, we should be able to give us which value? 11.2. So 11.2, we can use roughly 11% because it's closer to that. So you can roughly use 11%. So we are on the option list. So we are on the lease option. We are on the lease option. So leasing option, we start now with the leasing. We start off with the leasing option. We start off with the leasing option. So under that leasing option, we get the total payment. You want to get the lease payment. So under the lease payment, you check through under the lease. They say that lease payment is how much? So we start with the lease payment. Lease payment, which is meant to be 150,000. Apart from the lease payment, there is also repair and maintenance. It's also repair and maintenance. Repair and maintenance. Repair and maintenance. So what should be the repair and the maintenance, which is given in the question? 100,000. So we add them together and give us the total payment. Get the total payment. Get the total payment. Should be 200 and 250. So we less the tax because those expenses are taxable. We now less the tax. Tax should be 30%. 30% of 250. 30% of 250. So that you get after tax payment, net tax, net after tax payment, net payments. So that net payment should be which figure? 175. So that is now what we have. So once we get that figure, we now get the present value of the payments. We now get the present value of the costs. Present value of the costs. One now to get the present value of those costs. So it will be an annuity multiplied by present value interest factor for the annuity. So cost of capital, you have gotten 11% for how many years? 5 years. So our annuity is the 175,000. Our annuity is the 175,000. So take 175,000 from your table. What is 11% in year 5? The annuity table. 3.69. 3695. Like that. So we use the annuity table. We apply the annuity table. Then apart from that, still check on the lease option. They also say that the firm can choose to exercise the option to buy the computer at how much? After 5 years. So at the end of year 5, you have been given an option to buy, which you must exercise because you have been using it. It will be cheaper for you to buy because finally now the asset will be yours. So we also include option to buy. Option to buy. But this one we discount it using the first table because it only occurs once. It only occurs once. So present value interest factor 11% for 5 years. So that figure is how much? Option to buy under the leasing option. You buy it at how much after 5 years? 100,000. 100,000. So confirm what is 11% in year 5? 0.5935. So add those two figures together. It will now give us the present value of the costs for leasing. The present value of the cost for leasing. The present value cost for leasing. The present value cost for leasing the machine. $706, 132.5. Let us now go to buy option or buying option. We now go to proposal 2 is purchase option. We now go to the purchase option. We now go to the purchase option. We go to the purchase option. We now go to the purchase option. Let us check the purchase option. Purchase option. So under purchase option, there are some items we need to deal with. They talked about interest. They also talked about depreciation. So we can start with the depreciation. They have said that, you see, after the salvage value of the asset, which is estimated to be 150,000 after 5 years, depreciation is on what? Reducing balance basis. So it is not on the straight line. Normally on the straight line, you simply take the initial cost, you minus the salvage value, you divide by the economic life. That's normally what we do when it is on the straight line basis. But this one is on the reducing balance basis. Then again, they have not given you the depreciation rate. So we shall start by calculating the depreciation rate. We need to compute the depreciation rate that was not provided. So to get our depreciation rate, we start by calculating the depreciation rate. We start off by calculating the depreciation rate that has not been provided. So remember, future value is supposed to be given by the present value, 1 plus r raised to the power of n, if you recall. So we are looking for r. R is the depreciation rate. We make it the subject. So that formula, when you make R to be the subject, is the same as the compounding method of calculating G. It's the same as the compounding method of calculating G. So I make R to be the subject. It will simply be N, then future value divided by the present value. So when you make R to be the subject from that formula, finally it will be that value. So that machine was supposed to be there for how many years? 5 years. So N will be 5. Then the future value is the salvage value. The future value is the salvage value after 5 years. How much is that salvage value after the 5 years? So it is 150,000. Present value is the initial cost. That machine, the amount they borrowed to buy the machine, how much was it? It was 800. And now subtract 1. Then express it as a percentage. Then express that value as a percentage. They are getting which figure? Sorry? Online, you are getting which figure? Anyone who has computed online? So I'm seeing negative 28.545. So it is negative because it is a depreciation rate. If it was appreciation rate, it would be positive. So the reason why it is negative is because we are looking for the depreciation rate. But normally it should be positive. But now that you are depreciating, it must give you a negative figure. So we are getting negative 28.45%. So once we get the depreciation rate, we should now be able to calculate the depreciation per annum because it is now on the reducing balance. Let us now calculate the depreciation. Let us now calculate the depreciation. Let us now calculate the depreciation. So we start off with the initial cost. Start off with the initial cost. So initial cost of the machine is 800,000. So we less depreciation for year 1. It is on the reducing balance basis. We less depreciation for year 1. So depreciation for year 1, it should be able to be 28.45% of the 800,000. Of the 800,000. What is 28.45% of the 800,000? 227,600. So 227,600. So subtract so that we get the net book value at the start of year 2. Net book value at the start of year 2. So we get the net book value at the start of year 2. 5,725. Now we also less depreciation for year 2. Depreciation for year 2, which should be 28.45%. Multiplied by 5,724. Itakuja ngapi hiyo? $162. But you round off will be 840 what? 848. So you minus to get the net book value at the start. At the start of year 3. We get the net book value at the start of year 3. Net book value at the start of year 3. 409,552. So we also less depreciation for. We minus depreciation for year 3, which should be 28.45%. 409,552. 116,5. So that you also get the net book value at the start of year 4. 293,034. Then you also less Sorry? 83,368. So that we get the net book value at the start of year 5. $2,096 times. So for year 5, we shall not compute. It should be the balancing figure to get the salvage value or scrap value. So we are supposed to less depreciation for year 5. So that figure should be the balancing figure, so that you get the salvage value. Get the salvage value, which was 150. Get the salvage value, which was meant to be 59. Or you can calculate and confirm. The difference will be how much? Yeah, let's get 28.45% of 209,666. And see, you'll get how much. So that we compare to know the real why we should just have it as the balance figure. So get 28.45 of 209,666. It should be 59. Yeah, so when you minus this figure, there's a very small difference here. The reason being of the rounding off. The reason being the rounding off. That difference, is it 16 or 17? When you subtract me, it is 16. So that is the difference is due to the rounding off. If there was no rounding off, remember that 28.45% is also rounded off. So that is why we have that small variation. So that was how to get depreciation on that question. It was on the reducing balance basis. Depreciation rate had not been given. You had to calculate that depreciation rate. Another challenge in the question is that interest was on the reducing balance basis. Are you able to see that frame? Yeah, that means you also prepare the loan repayment schedule for you to get the interest because it is on the reducing balance. So let us also prepare loan repayment schedule to get the interest. Interest is on the reducing balance. Anything that is on the reducing balance, you come up with the loan repayment schedule. You come up with the loan repayment schedule. You come up with the loan repayment schedule. So in the loan repayment schedule, we start with the installment payment. We start off with the installment payment. So installment payment will be equal to amount borrowed. Amount borrowed. We divide by present value interest factor for the annuity. The interest rate is what percent? Is it 16%? For how many years? It was 5 years. So that amount borrowed was 800,000. It was meant to be 800,000. Then confirm in the table what is 16% in year 5. 3 points. 3.2. 3.2743. So you round off. It is 244. 327. So that is now your installment. Once you get the installment, we are now preparing the loan repayment schedule. We are now preparing the loan repayment schedule. So in that loan repayment schedule, we should be able to have the year, then amount at the start, amount at the start, then installment payment, installment payment. Also interest per annum, which is 16%. Then apart from that, will also be the principal. The principal amount. So we start off with the year one. We start off with year one. So amount at the start of year one is what was borrowed. It was 800. So installment is 244. 244, 327. 244, 327. Then the interest is 16%. So you get 16% of 800,000. 128. So subtract interest from the installment. We subtract interest from the installment to get the principal amount. To get the principal amount. Sorry? 116, 327. Yeah, so that's now the principal amount. So when you subtract that principal from this amount at the start, you get the balance at the end of year one, which is the same as the balance at the start of year two, which will be the balance at the start of year two. So subtract this figure from amount at the start to get the balance at the start of year two. 683, 673. So interest, what is 16% of 683, 673? 109,388. Subtract that interest from the installment so that you get the principal amount. 134. We also go to year three. We will subtract that principal amount from the amount at the start. 548. 734. 548, 734. Installment is still 244, 327. So interest per annum, 16% of 548, 734.
87, 787.
Sorry?
87, 787.
87, 797. So what should be the principal amount? 156, 530. You also go to year four. What should it be? The amount at the start of year four. 392. 392. 204. So what should be the amount for the interest? 62. 758. And 81, 574. So what is there as the amount at the start of year 5? So what should be the interest? 3,701. Now, our concern was simply interest. Whatever happens after that, it is of no consequence to us. So those two items were the ones which were involving in that question. They gave you on the reducing balance, depreciation on the reducing balance, interest also on the reducing balance. That was the only challenge in the question. But if they were on a straight line basis, we could not have gone that direction. But they say that they were on the reducing balance basis. So the challenge, another challenge in that question, because we want to get after tax payment. We want to get after tax payment. So the payment are only two. The payments are only two. The installment, you see the installment you pay, that's the first payment. Then when you check before the end of that purchasing option, you see before the end of purchasing option, there is service and the maintenance what? Cost. So there are only two payments, installment and the service and the maintenance cost. But installment has two components. Your installment, you can interest and the principal. So interest is taxable, but we don't tax the principal amount. We don't normally tax the amount we pay back as the loan. We only tax the interest. So there is a challenge there. We cannot tax this payment because it has another component which is not taxable. So we shall calculate the total payment separately. We also get the total taxable expenses separately. So taxable expenses are also three. Taxable expenses are also three. One of them is depreciation, we calculated. The second one, we calculated interest, isn't it? The third one is that service and maintenance cost. But depreciation is not a payment. Depreciation is not. It is just a provision to reduce the taxable income. That's why we shall have total payment separately, total taxable expenses separately. Once you get the total taxable expenses separately, then you tax them. Then subtract it from the total payment in order to get the after tax payment. That's the only challenge in the question. So first, let us get the total payment. Let us first get the total payment. Then after getting the total payment, we shall also come up with the total taxable income. The total taxable payment. So total payment will be equal to the installment payment. Then we are supposed to add the service and maintenance cost. The service and maintenance cost. So total payment, we shall simply be having the installment payment, then we add the service and maintenance costs. So installment is 244,327. 244,327. Service and the maintenance cost. You are given how much at the end of the question? It was 80. So add them together, give you the total. 324, 327. So that's now should give you the total payment. That should be able to give you the total payment. Also, we get the total taxable expenses. We also get total taxable expenses. Total taxable expenses or payment. So total taxable expenses. The first one is depreciation. We calculated that. The second one is interest. We calculated it. The third one is now the service and the maintenance cost. Those ones are taxable. Service and maintenance cost. So those are now the three items that are taxed. So we can start off with year one. We can start off. So can you check under depreciation? What was the depreciation for year one? Sorry? 227, 612. It is 600. Then confirm also interest for year one. Interest for year one was how much? 128,000. And the service and the maintenance cost is how much? 80,000. So you add them together so that you get that amount of the taxable expense. So how much is that? For 35,600. So you can leave a space of 4 lines for year 1, 2, 3, and 4. You can leave a space of 4 lines, year 2, 3, 4, and 5, so that we get after tax payment. So after tax payment should be equal to the total payments. Should be equal to the total payments. Then you less the tax paid minus the tax paid. So we start off with the year one. So year one, total payments, they will not change. Total payment will not change. It is 324. It is 324, 327. So tax paid in year one, you simply take these taxable expenses, multiply by the tax rate. So you know the tax rate is what percent? 30%. So tax paid will be 30% of the 435,600. These taxable expenses that you have calculated. So that now will be able to give you after tax payment. It will now give you the after tax payment. The reason why we separate is that under the payment, there is the principal, which is not taxed. Under the expenses, there is depreciation, which is not a payment. That's why get the total payment separately, get the total taxable expenses separately. So that you can have the total payment, then the tax paid is simply 30% of those taxable expenses. So how much is that for year one? 193, 647. So we go to year two. We go to year two. So payment is not changing. Payment is not changing. It is still the same figure. But I want you to go to year two. How much was the depreciation for year two? 168. How about interest? Year two. 109,388. Then also add 80. 80 is constant every year. 80 is constant every year, which is supposed to be which value? 352. So now the tax paid here will be 30% of 352 to 36. So which will be that value? It is 218. to round off to be 218, 656. So now I hope you understand the concept. Yeah, so can we do the same for year 3, year 4, and also year 5? Because the payment will remain the same. The payment will remain the same. The payment will remain the same. So what is changing? There will be the tax. You follow what you have done for year 1 and year 2. When you prepare the trading profit and loss account, among the expenses, depreciation is part of the expenses. That's what you normally do, even in financial reporting. So it is a taxable expense, but it is not a payment. So you tax it because it is taxable expense. So the reason why I said we are separating them is that there is principal in the payment which is not taxed. That's why you need to get the total payment separately. But depreciation is a taxable expense. So you include it. There is only 3 expenses which are taxable. There is depreciation, interest, and service and maintenance cost. Payment, there were 2 items there. There was the installment, but installment had an item we refer to as the principal amount and also the interest. But principal is not taxable. Then the service and the maintenance cost is a payment and it's also taxable. So depreciation should be worked separately. Then you tax that tax, then you minus to get the total tax. Yeah. The reason why we depreciate the machine, you remember even the other question when we prepared the cash flow statement. After we had depreciated and taxed, we added back depreciation. It's the same concept we are doing here. It's the same concept we are doing there. It is only meant to reduce the taxable income. So finally, we get the present value of those payments. So now get the present value of the costs. So there is the year after tax payment or after tax cost. Then present value, what was it? What percent? The discounting rate got 11%. Then get the present value like that. So year one, we go to which year? The after tax payment for year one. 193,647. Year two, we go to which year? 218. Then year three, 239,000. Year four, 56,491. Then year five, 2, then, but now, after that, the value of your asset. Remember the resale value. The resale value will reduce the cost in year 5. We are selling the machine at how much? So subtract 150,000 there. Because at the end of the useful life, you are selling it. So when you minus 150,000, the resale value, what are we left with at that point? 122? 370, like that. So the last year, subtract the salvage value. So in the table, 11% in year 1. 0.900. Year 2, it is 0.797. 8116. Year 3, 0.721. Maybe year 4 should be 0.6587. And finally 0.59. So multiply those figures by these values. Then add them together to give you the present value of buying that machine. The present value cost of buying the machine. So when we compare the two, which one has the lowest payment, net present value payment? So this time we pick the lowest. For NPV, you are selecting the highest. So which option has the lowest present value payment? So you will still select the lease option. We shall still select. Leasing is always the cheapest compared to buying. Lease is cheaper compared to buying the machine. So there is something remaining on the replacement. There is something remaining on the replacement. So we shall be able to meet on Sunday from 7. We do the item for the replacement. Then we shall still meet on Monday. Our class is normally on Monday. Yeah, so I've given you some notes on the international financial management. Online, when you check through the class group, there is something to do with the international financial management, the financial derivatives. So we shall finish on Sunday the replacement so that when it comes to that Monday, we shall now go through the derivatives. So if there will be a need, I will add you another class before maybe by Wednesday, so that from there you revise on the basis of what we have covered. So we can stop there for today, but remember on Sunday, we have a class from 7. We finish the part for the replacement. Then once we finish the part for the replacement, there's some notes I've sent you to the class group. The one for financial derivatives. Then we should be able to finish that part by the following class in case we don't finish on Monday. So we can stop there. The recordings are normally sent to the class group. So they will be able to send to the class group for the recordings. So you can stop there for now. Yes.
Where are we looking at the worst?
Sio NPV, hii ni costs. Hiyo ingine ilikuwa net present value. Hii haina revenue anywhere. Yeah, this one was based on costs. Ile ingine ilikuwa na savings. Haiko, hii haina. So this one we approach it from the cost side. Yeah, but for the other one we approached it from the present value of the cash inflows. So we can stop there for now. Yeah, that question was repeated. When you check